Kia ora, and welcome to the CoreLogic Property Market Update for Haki Hea 2021. Here we are, another year down, and an eventful one at that. We'll take a look at the year that was shortly, but firstly, a recap of the most recent data points. Sales volumes have held up as we move to the end of the year, though we must note any year-on-year comparison actually shows a significant drop. But the context here is that it was this time last year when the market really took off. So those comparisons can be slightly misleading. The recent lockdown also muddies the waters somewhat, with the extra strength in November sales likely reflective of a bit of catch-up from restricted transactions that did not occur in the months prior. Nonetheless, momentum has come out of the market as affordability bites and lending gets tougher through tightened restrictions and increasing interest rates. Property values have continued to increase though, and at relatively high rates. However, the monthly rate of growth slowed in November after the expected mini bounce in October. This was influenced by the Delta lockdown, with fewer listings coming to market, but no drop in demand. A temporary boost to prices was inevitable. But much like the catch-up in sales since lockdown, listings have also bounced back. And with fewer properties selling, overall inventory levels are lifting across the country. In fact, almost half of our regions now have more properties for sale today than they did a year ago. In Manawatu, Wanganui, Hawke's Bay and Wellington, stock levels are 40% higher than last year. So changes in the air, and while buyer activity hasn't seen a dramatic shift yet, there are signs of first home buyers reducing their activity, almost certainly as a result of fewer being able to secure a purchase with a small deposit, since the tightened LVR requirements came in on 1 November. Looking back at the whole year, our prediction of 2021 being the year of property politics definitely came true. Regulation and intervention were consistent topics throughout the year. And while they'll still remain a factor next year, we're unlikely to see the same level of intervention in 2022 as everyone waits to see the impact of this year's changes. A brief look back at the timeline of 2021 illustrates the complexity of changes to the residential property market environment. From a lending perspective, we had the early reintroduction of the loan-to-value ratio restrictions in March, which were tightened for investors in May and then for owner-occupiers in November. And now, debt-to-income restrictions, which are a new tool in the Reserve Bank's toolkit, are playing a part, alongside increasing mortgage interest rates, courtesy of hikes in the official cash rate. We had the surprise government announcement on March 23, where investors were targeted via the phased removal of the ability to write off interest costs in year-end tax returns. For fresh buyers of existing properties, interest deductibility ended straight away. The bright line period was also extended to 10 years. Although it's worth noting both changes exclude newly built properties, to ensure the supply side is not affected. Finally, the proposed changes to the Resource Management Act, or RMA, caps off the year. The final reading has passed in Parliament, which will allow for easier intensification of building to occur where it's needed most, in our biggest cities. The construction industry itself has garnered a fair bit of attention, with record consents being issued, but skyrocketing costs alongside. Things are unlikely to change much in 2022, so this will remain topical for the government and private sectors alike. There has to be a risk that at some stage next year, rapidly rising costs choke off demand to launch into a new build, seeing dwelling consents drop back. Looking ahead, and our expectation for next year is of a gradual slowdown. The market headwinds are stronger, in particular with affordability being further stretched. Continued value growth, tightening credit, and increasing interest rates are all key factors impacting the ability and amount of funding which will be able to be accessed. For investors, you can add reducing yields and lower profits to those headwinds. But despite the headwinds limiting upward price pressure, we're not expecting strong downward pressure on the market. A strong and resilient economy, alongside responsible lending standards, means the market looks relatively insulated from a major downturn. We have a record low unemployment rate and a tight labour market, which should reduce the likelihood of motivated sellers willing to take any price. Of course, we need to consider the potential impact of COVID too. And while hope and expectations are for less disruption next year, there remains continued uncertainty on when the borders will open in full, and how some businesses will cope when all the central support ends. On that note, don't necessarily expect net migration to surge higher after borders loosen. After all, there'll be a lot of current residents who will look to leave Aotearoa too. But for now, increased supply and reduced demand will probably lead to a period of standoff between vendor and buyer, before a genuine buyer's market emerges. That's where things are heading though. 2022, the year for the buyer. If 2021 taught us anything though, it's never plain sailing. And we'll be keeping an eagle eye on everything property related throughout the year. Make sure you subscribe to our weekly property market podcast for our regular takes on the changing dynamics of the market. For a comprehensive recap of 2021 and a preview of 2022, check out our recent webinar and read our Best of the Best report, detailing property market performance across a range of different measures right at the suburb level. All available at CoreLogic.co.nz. Meri kirihi mete, happy holidays, mā te wā.